Hi everyone, welcome back to Corporate Decoder. Today we're diving into a report so detailed it could cure insomnia, or maybe cause it depending on your excitement level for municipal bonds. Just kidding, we'll try to make this interesting. Seriously, we're looking at a shareholder report for Voyageur mutual funds too, specifically their tax-free funds. The big takeaway, we're checking in on how these funds are managing your money and what kind of returns they're generating. First off, this report covers the 6 months leading up to February 28, 2025. It gives us a snapshot of how these tax-free funds performed during that time frame and how their holding were allocated. This matters because it is your money that is at play. We'll focus on the Macquarie tax-free Colorado Fund Class A shares to keep things simple, but we'll also check in on some key numbers for the other funds too. Let's talk about cost because nobody likes hidden fees. This fund lists its expenses based on a hypothetical $10,000 investment. For Class A shares, the cost of $42. Translated, that means you are paying 0.084% of your investment annually. Alright, let's check out some key stats. The total net assets for Macquarie tax-free Colorado funds sit at $20.47 $3 $30.47 $47 The portfolio turnover rate is 4%. This tells us how actively the fund is buying and selling investments. A low number like this means they're not trading very often. They have about 160 holdings. Where is all that money invested? Let's check out the fund's holdings. The biggest chunk, 20-30%, is in healthcare revenue bonds, then 18-49% are special tax revenue bonds, and 12.6% is in education revenue bonds. It means your investment is spread across different sectors with a focus on healthcare and education related projects. These bonds are also mostly from Colorado with about 79.69% dedicated to those. Now let's briefly look at the Macquarie tax-free California fund. There's a disclosure here about how they handle mailings. If multiple people at the same address own shares, they will deliver a single copy of reports to save on expenses. If you want individual mailings, you have to call them. Scrolling through the fund's holding, we can see they have similar strategies compared to the previous funds. It is mainly concentrated in municipal bonds from California and spread across the sector of revenue bonds. The largest sector allocation in the fund is the healthcare revenue bond. The fund allocated over 47 million into this specific sector. Checking in the state allocation in each fund, we find a similar story with the Colorado fund. The investments of each fund are concentrated in the source state. As a reminder, there's also a section on fund costs based on a hypothetical $10,000 investment. So it is recommended to check those values in order to have a better understanding if the fund matches your criteria. Finally, let's take a quick peek at the Macquarie tax-free Arizona fund. This fund allocated over 16 million in education revenue bond, making it the largest investment sector. Checking the holdings again, Arizona Industrial Development Authority revenue has a good allocation in the portfolio, having around 1.000 in value. And of course, as we discussed before, all the other funds have an information table relating to each fund cost and net asset value. These are very important to check. This section indicates they don't need to disclose anything about compensation clawbacks, meaning no executives had to return money they didn't deserve. Finally, there are legal certifications attesting to the accuracy of the report signed by the CEO and CFO. Standard stuff, but good to know it's there. Okay, so what's our take on all this? Overall, these Macquarie tax-free funds seem pretty straightforward. A primary benefit of these funds are the low cost of investing compared to other. That helps you keep more of your returns. However, with the lower investment comes some risks. These funds are heavily concentrated in specific states, and that can be risky. It means that if something bad happens in, say, Colorado's economy, your investment could take a hit. Having such a large allocation in a specific geography is not inherently a bad thing because the fund can also benefit from potential upsides of the local economy and sector they are exposed to. Thanks for watching. If you found this breakdown helpful, please smash that like button, leave a comment with your thoughts, and subscribe for more corporate deep dives.